Hey YouTube, what's up? It's Victoria from TRADEPRO Academy, and if you're watching this video, you've probably seen what has happened over the past 4 weeks in the market, right? We went from all-time highs into a Christmas rally, doing amazing, everyone's cheersing during New Year's, into a 12 to 13% drop from all-time highs in the SPX, and the NASDAQ even more than that, very close to corrective territory. Now, if you're watching this video, you're probably looking for reasoning and research as to why the market may crash in 2022. So that's exactly what I'm going to provide for you guys today. We're going to be talking about a few factors that are in depth, right, from beginner to more expert trader and investor as to why or why not the market may crash in 2022. Now, we've already had a rough start. We're already down 2 times more than the biggest dip in 2021. And these ever-changing market conditions are due to a lot of different facts that we need to talk about. Now, what I'm going to discuss here today is going to be the transition from a bull market to a bear market to a bull market. Will this frivolous bull ever end? Right? Typically, we do see blips of back and forth, and we're going to discuss some of the past patterns that we've seen in a while, and we're going to factually base our thoughts and our processes for the 2022 potential crash. Now, if you want to know more about the 2022 market and some of our anticipations, we posted a video, I think it was earlier on this year, you guys can check it out here, of our anticipated moves in 2022. Now, overall, maybe the actual numbers and levels were a bit off, but we were right on the direction and the sector rotation, which is one of the most important aspects of this. So if you guys are excited for this video, I want you guys to smash that like button, hit that subscribe button, and ring that little bell to notify you when we do drop videos like these and go live. So in the comments down below, I want to see what you guys think. Are we gonna crash 20, 30, 40, 50% in 2022, or is this bull going to last? Let me know down below and we'll see what's up. Welcome back, and I'm glad that you guys stuck around, because first we have to explain what the premise of a bull market versus a bear market is. Now, each of them has an average lifespan, and each of them can be defined in a certain way. So the bull market's average lifespan is about 2.7 years, where we continuously slope up in the market, right? As things go well, you can see that earnings start increasing, prices start increasing because of that, and companies slowly pump the market up. Now, the average bear market would last about 9.6 months, right? About 10 months, very, very close to a year. And that is when the market slumps down, right? Gradually, but more in a brisk fashion than the overall lasting nearly 3-year bull. So this happens on a rollover period about 3.6, 3.8 years. Now, to define the bear and to define the bull market is typically a 20% rise, right, from a low or more intermediate low. And this has clearly happened because since the bottom of the 2008-2009 financial crisis, we're up about 500% in the S&P 500 index, right? Since the lows of the COVID crash, we are up about 115% on the S&P index. So keep in mind, this is a very frivolous bull. Now, in between, there have been a few turnarounds where we've seen the bear market defined as from the highest point, from the most intermediate high, a drop down of at least 20%. So we've seen that a few times, right? We saw that in 2020. We haven't seen that since, naturally, and it lasted about a month to 2 months' time. Right? Now, the 2020 was the last sizable crash between about February to like April-ish to maybe late March, something like that, where we saw a very significant 35, 34% drop from the all-time highs in the SPX index. Now, the forward PEs, right, the price to earnings ratio in the index went from 19.2 all the way down to 13.3 with an average about 15 on a regular base. So these are important numbers to remember, as we'll talk about them soon. Now, what I want to do is I want to compare what had happened in 2020 and compare it to 2008. Now, I know there's completely separate events, and people who compare the two, right, and say, this is what's going to happen based on 2008, that is a completely different scenario, and you can't compare them, but you can compare the numbers in terms of increase and decrease in PE ratios. So from the COVID lows, we've rallied about 115%, and the PE of the SPX was mid to low 20s, right? X, which is the forward PE ratio, right? So around 22, 23 PE, which is a pretty solid increase from the highs just before the crash, but not that drastic. You'd think it'd be a lot more. But remember, the average is around 15. Now, in comparison to what happened in 2008, from November 2007 into 2008, we had a 408 days, so over the calendar year of a bear market which dropped about 51%, right? We had a small rally, and then in 2009 we had another bear market that dropped over 20%, right? So this massive event lasted over a year and a half, right? So we had this massive bear market, which was the last real bear market due to the financial crash, right? And a much larger recession. So if we compare the two, right, the COVID dump seems a little more insignificant. So what was that significance, right? As you can see in the picture, from 2007, it took us about 4 years, right, after the lows to recover back to break even of the highs in the market. Right? So naturally, there were a lot of differences in terms of quantitative easing back in those days, right? Rate cuts, rate hikes, whatever, all that good stuff. But the quantitative easing measure took a very long time, from 2008 to 2014, which is one of the main topics that we're going to talk about, and the Fed throughout this 2022 crash analysis. Another big difference was also the housing market bubble and the overall financial crash, right? This is very important to know because this is one of the main catalysts that propagated this whole dump in 2008, 2009, right? I was pretty young at the time, but I do remember just very slightly that there was a lot of mayhem and panic on the TV.
Bear Stearns is not in trouble. I mean, if anything, they're more likely to be taken over. Don't move your money from Bear. That's just being silly. Don't be silly.
Now, that catalyst, right, is not necessarily present in today's system as of yet, right? As of now. There could be something there could not be something there. So let's just keep that in mind. So now begs the question, it's 2022. We've ripped a lot since the lows of 2020, right? A lot of money was injected into the system. So where do we stand in terms of a potential crash? What can we see this year and the next year? And what's going on with the state of the economy, and how fragile is it really? Now, there are a few factors that I'm going to talk about today, and they're going to be split up and they're going to be broken down from basics to a little more advanced so we can understand, right, what the potentials are of a market crash in 2022. Now, there are 4 main things that I want to talk about: the Federal Reserve, the stock valuations that drive the market, the overall arching market bubbles and mean reversion. Then we're going to talk about my closing thoughts on this whole process. So it's going to be a lengthier video, and you guys can see in the chapters, you can probably skip ahead. But overall, these are going to be the main topics that we're going to be talking about, and we can see, will there be a crash in 2022, right? What are the probabilities? What are the other outcomes? And let's dive right into this. So number 1, let's talk about the Federal Reserve. The Federal Reserve and its quantitative easing metrics. Now, we're doing a little comparison between 2008 and also 2020. Now, the metrics are very skewed, right? It is a larger difference, right? There is more money in 2020 and 2021 right now. But if we take a look at one of the larger overarching problem is going to be the Fed, right? The Fed has to take monetary policy actions right now because of what it did in 2020 to help revive the market, right? Remember, in 2020, we had this giga quantitative easing that shook the market by storm, and we injected, right? We just like machine gun sprayed all the money and all the liquidity into the market. So doing that, right, we revived this 35% drop, but that came at a cost, and now the market is looking like it wants to pay the cost. So overall, if we take a look at 2008, right, from 2008 October to about December 2014, we saw 4 rounds of quantitative easing that was a response to the financial crash. At the time, the Fed chair was Ben Bernanke, right? He was injecting money and liquidity into the market at a very easy rate in comparison, right? When quantitative easing started back then, the balance sheet was under $1 trillion, right? Under $1 trillion. Now, the first round came very fast and it jumped above $2 trillion. So we saw a 2x increase in a matter of months in 2008, and then it started easing off, but continued for a very long period of time that ended with a taper tantrum in 2014, right? So 6 years of quantitative easing was no joke, because we rallied from just under $1 trillion of a balance sheet into $4.4 trillion somewhere at the peak that revived the lows of the financial crash, right? So that is a 4x, 4 and a bit x increase in the balance sheet, and that's where things started to go a little awry. So you guys can see this drastic image of the balance sheet, and you'll notice there are some rips, there's some dips, there's some sideways movement, and we'll talk about the sideways movement, of course. But in 2020, you can see the balance sheet was hovering around $4 trillion, right? Balance sheet was hovering around $4 trillion, and you can see this pretty much vertical parabolic rise in the balance sheet at one point, and what had happened there. So that is the crash, right? The COVID crash that we saw that dropped the market about 35%, and the Fed was very quick to inject money into it. Now, it seems like it's a very big difference in terms of what had happened in 2008, but the number itself is larger, just the quantity in terms of the multiple is a lot smaller. So we went from about $4 trillion to about $7 trillion very quickly, $3 trillion, which is greater than the $2 trillion injected, right? But it is not a 2x increase like we saw in 2008. But the thing is, we didn't really ease off too much, and we continued to inject money, right, at a much more extended rate, and now the balance sheet sits under $9 trillion. So a very quick injection. The injection has continued. Now, what is the Fed to do? What had happened from this? What are the repercussions from this? Because just like we saw in 2015, even in 2018, when we started easing off of the quantitative easing, we saw a larger dip in the market, which created like a 15-20% blip, right? What did the Fed do in 2020 that caused this problem? There are 3 things that had happened and that we're going to focus on. Number 1, it created a very low cost of borrowing, right, which inadvertently was put into the market. They also inadvertently, right, not directly, indirectly injected money straight into the market, right, by their bond purchases. And finally, due to this, they created a massive surge of inflation. Those are going to be the 3 topics that we're going to focus on today and how they could relate back to what if we get that seismic shift and a financial crisis in 2022. So remember, the S&P 500 index rose 150% from the COVID lows, right? What this did was it increased inflation to about 7%, while the Fed's funds rate was about 0%. So the cost of borrowing was extremely low. Now, the inflation created a huge issue for long duration assets and also big tech names that don't necessarily do well in these kinds of environments. Now, to add to this, right, the Fed has to fight this 7% inflation that came up from about 2% to get it back down to 2%. So there's a few things that they could do to kind of haul this back. And one thing is starting to increase rates, right? Starting to hike rates. And when they start hiking rates from net zero, that is going to be an adverse effect on the overall market. Now, that's not the only thing. Remember, the balance sheet is nearly $9 trillion right now. Another way to fight inflation is start to unwind the balance sheet, which means that they're going to lay off, right, those bond purchases that they made. So now that they're not going to be holding those bond purchases, right, that's another seismic move that shifts more to the bear side in the overall equities. And then the third thing that they're going to do is taper, right? So the tapering is just taking a bit off of the injection of cash, right? They're still going to be injecting cash, but it's going to be to a lesser degree. Now, these repercussions were foreseen, right? This happened very aggressively, and there was no way that the Fed would have just, hit their little wand, just whipped the little wand around and everything would have been A-okay, right? We injected a crap load of money into the economy very aggressively, and there are going to be repercussions, right? Inflation was going to go up. There were going to be overinflated assets. So now the Fed is forced to start hiking rates in a more fragile environment, right? Now, in December, the Fed talked about increasing the taper, which we'll talk about, but also starting a Fed rate hiking cycle, which signaled pretty much the top in equities. So we've seen a pretty sharp turnaround since then. As you guys can see, the super hawkishness in the Fed has downturned the market, and they're expecting to have the first rate hike now that's been confirmed by Jerome Powell in March 2022 of about 25 basis points. Now, overall, the general consensus is about 4 rate hikes this year, and there's 8 total Fed meetings. Now, Goldman Sachs says there's going to be 8 rate hikes, which is a little aggressive, and JP Morgan thinks there's going to be 7 rate hikes. Now, their analysts are notorious for being wrong, but that also seems like a little more of an aggressive hike. Now, one hike, right, is 25 basis points, 2 hikes are 50 basis points. So they might weasel in a few 50 basis point rate hikes here and there. But overall, those are pretty aggressive moves to fight inflation. Now, when we had this news, right, and we had this super hawkishness, the market did start turning down and we had a more cataclysmic drop now that the rate hike is pinpointed 90% for March and Jerome Powell said so. So let's talk about hawkishness. Let's talk about the actual effects in just layman's terms of this market. So imagine this, right? The Fed is now hawkish. So before, it was super, super easy to borrow at a very low cost. What hawkishness does is increase the rates, right? Increase the rates of borrowing. So now your return on investment is lower, making things less attractive. So how does this correlate to bearish equities? Just take this for example. So imagine you can borrow, right? Let's say $10,000 from a friend at 2% interest, right? Whatever the amount of money is, you're borrowing at 2% interest. Then you can go around and invest it and you're gonna make 10% return this year. So the net of that after you pay your interest, you've collected 8%, right? You've collected your 8%. Now, with a rate hike, the cost of borrowing is gonna be that much more expensive. So instead of borrowing for 2%, maybe you borrow for 4% and you go back and you return 10%. You're left with net 6% of the gains, which is less than the 8%. But now think of it this way. You don't want 6% net. You wanted the 8% net. So you're going to wait around and there's going to be less demand for such environments, which causes less injection of capital into the market in different aspects. So that means that 10% return is now going to be 8% return. And that means your net is 4% now rather than 8%. So the demand decreases when they start increasing the rates, which causes the bearishness and hawkishness of the market to actually downturn. So when the Fed was just cutting to 0%, right? Everyone was borrowing. Everyone's like, oh, okay, well, the market's in a downturn. The Fed will save it. I just put this money into the market and it quadruples, right? And I go and pay that interest rate. Fine, right? Now that they're hiking and the market's downturning, the exact opposite happens. The Fed's mission, remember, is to return the economy to normal, number one, right? Through employment and also fight inflation. Now, we talked about rate hikes. That's one way. Remember in 2008, they cut rates so much that the only other thing they could do is start quantitative easing. Now it's the reverse, right? Now they're hiking rates, but there's a few other things because they eased so much. Instead of doing quantitative tightening and just rolling back the balance sheet, they have another alternative before they do that, right? So they started hiking rates. Now what's another measure to kind of combat all this stuff? The other measure is going to be tapering, right? We're going to start tapering. Now tapering is the act of still providing stimulus, right? Still providing bond purchases and money into the economy, but doing it at a slower pace. So number one, they said that they were going to expedite the tapering process in December. Originally, they said they're going to roll it back by $15 billion. So right now, they're injecting about $120 billion on a monthly basis. Now, the original rollback was $15 billion. So that means they would still inject, but $115 billion on a monthly basis. In December, they say, you know what? What we're going to do is we're going to double that amount to 30 billion. So now we're only going to be injecting 90 billion. So the speeding up of the taper process, right, no longer providing those funds is going to be more of a bearish catalyst. And they want to do this because they want to cease the influx, right, this quantitative easing just continuously sooner rather than later. Right, originally planned to cease in June, now it's planning to cease before the rate hikes in March. So that's why they doubled that. Let's break this down into just regular terms, right? So imagine you're on a diet, right? You're on a diet and you want to lose some weight. You're going to be eating food naturally. That's what happens when people crave sustenance, right? If you have to live, you're gonna eat food. So you're not gonna go cold turkey and be like, hey, you know what? I want to drop 20 pounds. I'm just gonna stop eating for the next week. Right? That'd be the same thing as the Fed. You know what? Like no more influx of money. We're just going to cut it cold turkey. That's not how it happens. You have to just ease into it. So now if you want to lose weight, right, you're going to eat less than you originally did, but you're still going to eat. Now, George likes to use the example of the addict, right, which I don't really like too much, but it makes sense, right? Imagine you're addicted to cigarettes, right? And you're smoking 10 cigarettes a day and you're going to stop. Right? You're gonna stop, but you're not gonna go cold turkey, right? Instead of 10 cigarettes, originally they say, you know what, you're only gonna smoke 7 today, right? I'm still gonna give you cigarettes, but it's gonna be 7 instead of 10. And then all of a sudden they say, you know what, I'm still gonna give you cigarettes, but it's gonna be 4 instead of 10 right now, right? It's gonna be a massive clawback. You're still gonna get your goods, but it's gonna come at a cost for you, right? Now, one of the final steps to kill off inflation, right, that the Fed has is they wanna get inflation back down to around 2% by the end of the year, right, from 7%. And that's gonna be by quantitative tightening, right? It's the opposite of easing. So before easing, they're just injecting money, right, expanding the balance sheet. Now with quantitative tightening, they're pulling back the balance sheet and they're not injecting money, right? They're pulling it back, actually. They're unwinding the balance sheet. So remember this chart, you guys can see it on the screen here, and overall, in 2014, 2015, that's when they stopped the quantitative easing cycle, and you can see the quantitative tightening actually started in 2015. Now in 2015, they dropped it down a bit, and that is when we got a blip to the downside in the markets. So overall, right, something similar is probably gonna happen, which could cause or be one of the catalysts to see a downturn in the overall market. This becomes a bearish event. So let's compare what happened with the 2015 kind of quantitative tightening and versus what could happen in 2022 with this tightening. So remember, we're gonna add 3 different things together, right? Quantitative tightening that we just talked about, the tapering that we talked about before that, and the rate hikes. So all 3 of these, right, after so much liquidity has been injected into the markets, it becomes a pretty bearish event overall. Now, Powell said in January in the past Fed meeting, right, it was seen as hawkish, but it wasn't necessarily anything that we didn't know just yet. But throughout this event, he mentioned a few things, right? He mentioned that they're going to start hiking in March, which we already knew necessarily, right? The odds were already 90%. They said the taper is going to conclude in March, which we already knew. And then he did mention one thing that we didn't quite know for certain yet, but the quantitative tightening cycle. Now, the quantitative tightening cycle, he didn't mention, okay, it's going to start here, it's going to start now, it's going to do this and that, but rather he said, if it should be the case, then it is going to happen after the rates have been hiked. So it becomes a last portion resort. Now, one of the cases to get a larger 20-25% dip from highs in March, because that's typically when things happen, it's a seasonal aspect, even though in January we're already down about like 12% in the S&P 500 index. But if we want to get the turnaround that's going to be that big, we would need surprises to the most bearish, right, annotation pretty much. So what we had talked about, bear it up. And what I mean by that is instead of in March we have a 25 basis hike, we see a 50 basis point hike, right? That's going to be more bearish. That's going to be an aggressive bear. That's really going to stir things up and cause one of those really downshifting catalysts, right? That's step number 1. Step number 2 is in March he actually says, you know what, we're going to start quantitative tightening by June, July, whatever it is, right? And he gives a date and he specifies it. And that's going to be one of those more priced in, cataclysmic, sizable events that does pull the market down, right? Because those are very, very bearish things to say in an economy that's still struggling with employment and is still recovering from what we have seen throughout the last 2 years. So the Fed does make the case to turn things back around. And one of the reasons is, remember, the Fed is at near zero rates, right? Imagine a financial crisis of some sort, maybe a housing bubble or whatever pops, right? We get a bubble pop. What is the Fed possibly going to do in an attempt to combat it at a 0% rate with a $9 trillion balance sheet? There must be, right, when the economy comes back to life and the economy is good enough to sustain tightening and sustain rate increases, we have to wheel everything back just in case one of those seismic events happens. So this is a precursor or a precautionary move just in case, right, something may or may not happen based on these overvaluated prices. So let's take a look at the second step, the second factor that we're going to talk about, speaking of overvaluation, and that's going to be stock market valuations and the overvaluation in the market that was caused over the past 2 years. Now, the Fed blabbing is over and the valuation talk begins. So it's no surprise that a lot of assets have been overvalued. So there are a few metrics that you need to look at as a just investor, trader, whatever it is, a market participant, and that's going to be the price to earnings ratio, right? Price to earning, price to sales, because those have to be congruent based on industry standards, right? So for example, if the tech industry on average has a price to earnings ratio of 25x, 30x, then realistically if the price to earnings is at 50, for some companies, then it's going to be considered overvalued, right? You're paying way more than the earnings suggest that the company is worth. So that had happened throughout 2020 and 2021, right? Some assets more than others, and we've seen those sharper declines. Now, it's also happened in the general S&P 500 index that is now sitting in the low 20s of a PE ratio, which on average it's about 15. So this price discrepancy usually mean reverts back into fair value, where it becomes a more attractive investment for a lot of investors and money managers, right? So to say that prices are overvalued, that just means that we have to return to fair value, and the way isn't going to be by exponential increase in earnings, because remember, we did have supply chain issues, we had the COVID crash, we had COVID all throughout the world, right? Those supply chain issues did stagnate earnings in a lot of companies, and now inflation is doing just the same. So realistically, earnings have suffered a little over the last 2 years, right? They've grown a respectable amount, but obviously the prices were overinflated because of money just being injected. So the natural solution to this, or the natural phenomenon that will occur, is that the price will catch down to get back into what we call a fair value earnings per share, right? A fair value price to earnings as well. So there are a few names that we mainly look at that dictate the general market movement, because they're 25 to 30% of each massive index. And those are the kind of just the big mega cap tech names. So we've got Apple, Microsoft, Amazon, Tesla, Nvidia, and Google pretty much, right? So those main 6 or 7 names are going to be the names that we look at to get a little more guidance in terms of, okay, where is value, where is unfair value, and then every stock around that, we'll talk about that as well, because those valuations have been skewed super aggressively, and we see these massive price increases. So let's take a look at that and understand that from more of an investor perspective. So in general, when the names that I had mentioned, right, their prices go up, and they're artificially inflated, their price to earnings are going to go up. Yes, they have earned more. Their earnings are great, right? They've been growing steadily. But if they have an industry average, right, and have a fair value average, and they stray away from that, the logical move is going to be investors pulling money out of them to take their profits and invest elsewhere where we have undervalued or fair valued names. So let's take a look at what this means. So Apple right now has a price to earnings about 28.4, which is a little higher than expected, right? I'd say fair value is between 18 and 20 for it. So there is a little more to drop to be considered undervalue and fair value. Now, this increase wasn't that drastic, right? It's been a lot higher, especially in December and November, when the price to earnings ratio was closer to about 40-ish, right, 35. So now that we've seen a little reversion in that, it starts to become more of an attractive asset, right? And what had happened to do that, right? It hit $183, a $3 trillion market cap, and since then it's down about $20, 20 points, and that's coming back down into what we consider a normal value for Apple. Next up, we also have Google, right? Google is one of the bigger and juicier earnings names, right? It's stagnated for a very, very long time before the post-COVID pop. And right now it's sitting at about 24.8, 25 PE ratio in terms of its fair value, which is considered to be around 28, right? So it is at fair value. It's even undervalued. If it drops towards 20, I know a lot of big money and investors are going to be all over that. Next, we have Microsoft that's sitting around a PE of about 33. The fair value could be considered between 33 and 30, right, somewhere there. So it's dropped quite a bit, and it's become a very attractive area, right? The more it drops towards 20, the more it's going to be an attractive investment, and that could signal a lot of dip buying. Now, we also have Nvidia. Nvidia is a higher PE ratio because its earnings aren't as great as its price. Its price was once like $800 before split, and now it's about 35%, 40% off of all-time highs. So it's very volatile, but it has huge, huge potential in the AI space. Now, Nvidia PE is hovering around 70. The fair value is considered between 60 and 65, so it's very, very close. We also have Tesla, right? Tesla is one of the massive, mega, known for having no earnings, no profits, but just rocketing to 1,000, right? PE is around 300, fair value is considered to be around 300. So Tesla is dropping in terms of price to earnings, but not because the price is dropping, but it's going to have better and growing earnings, which is good. And then we finally have Amazon. Amazon's on the higher end of things as well. Amazon is sitting around 54, right? It dropped under 3,000 very recently, and the fair value is considered around like 55 to 60, right? It could drop a little more, and a lot of people have been expecting a stock split, so maybe that's something in the near future. Now, these PE ratios are important because it tells you how much people are willing to pay for things based on their earnings, right? How much things are overvalued and undervalued. Now, naturally, if a company doesn't have bottom line profits, right, and the price is extremely high, like we saw in a lot of growth names. Remember Kathy? I'm sorry, Kathy. What have we done to you? But remember Kathy, right? Like a lot of her growth names, they have like 400, 500, 700 P without an ounce of profit. But also these names are up like 3,000%. Well, okay, maybe not 3,000, but like 300%. Right? ARK from the lows over the past like 10 years has done incredibly well. It's just that these PEs got super overvalued by a lot of speculation, and now they're coming back to what we understand as fair value. Money is flowing out of them. There's no need for them anymore. They're way overvalued, and it's parking elsewhere, right? It's parking elsewhere in quote unquote better valued names, safer names. So around August, right, we had this influx and we had a PE spike, and the overvaluation was pretty much priced in, right? We had prices that were very, very heavy, and in the summer, money outflowed from those heavy PE names as inflation fears began to rise, as rate hike fears began to rise, and we saw money flowing out of aggressively overpriced names and into, right, these larger cap, mega cap tech names, because they still have the potential, except they're not extremely overvalued, right? For example, if you have like Square at a PE of 100, right? And then you compare it to Apple at a PE of like 20 at this time. Square doesn't even make profits, right? People are gonna take their money that they've made, get the hell out of there, plunge into Apple for a steady ride up, right? So that's when we saw, you guys can see on the screen here, the outflows of the NASDAQ. The outflows of the NASDAQ are the red oscillator at the bottom, and you can see on a weekly basis, there's barely any inflows of money. So tech had reached a peak in terms of breadth a very, very long time ago, and a lot of the money was flowing out of names that were way overvalued and into names that had that safer potential. So how is the NASDAQ, the NDX, going to continue ripping highs into late 2021 when there was only Apple, Google, Microsoft, and a few other names that were actually ripping with it, right? Just because they're 30%, even more of that index itself just propping everything up, right? It has that potential and that possibility. But at some point that has to crumble, and we don't necessarily see those names inflowing with cash. So why did that come to an end point? When you saw the peak in like early fall, you saw the massive inflows coming into defensive names and outflows coming out of tech names. So why did that happen? Inflation fears rose aggressively, and tech names do not do well in inflation. Not to mention, right, rate hikes and the extreme hawkishness of the Fed started to appeal to a more safer space. So a lot of tech names got money flown out of them and into Apple, Microsoft, Google, right? The names that were sustaining dominance. And even though there was more to be had, sector rotation had already stricken, right? We've already started moving into late cycle names and out of tech. And if tech loses ground, then the overall market's going to lose ground. It's very simple, right? Now, these attractive PE ratios, right, have come only because the market has slipped a significant amount, so it becomes more attractive for investors yet again. But the one thing is, it has not yet become more attractive for investors in the grand scheme of things. Remember, if you take a look at the 6 names that we have on the list, remember there's way more names in the overall market, right? There's 500 names on the S&P and there's 100 names in the NASDAQ. Now, if the majority of these are overvalued and the NASDAQ only about 10, 15, 30% of the names are above their 200-day moving average, right, it's going to pull the overall market down. It's going to pull it a lot lower because those names haven't come into fair value and they haven't become attractive for investors in a way to park their money as they once did. Why? Because inflation fears are looming and borrowing costs are not as cheap anymore, and the Fed is not injecting money left, right, and center into this market. It's very simple. So now what is going to happen with the sector rotation? Late cycle names are being favored and money is flowing out of tech continuously until valuations are met in that they want to be invested by investors, right? Valuations to be fair value or undervalued for investors, and that may not come for another 10, 20, 30% more drop, even if some names of the tech sector are down 30% from highs, right? Only the investors can determine the fair value. But for example, if you're in an industry other than the big names that I mentioned, and then the average of the industry is about 20 PE, right? But let's say 90 of those names are trading at 40 PE. You have to cut it down in half, right, to get the PE that you want. So that could further continue more downside. And those names like Microsoft, Apple, and company are not going to just magically go up by themselves, right? If everything drops, those are going to drop as well, and that creates a larger dip in the market. So if these overvalued names continue to be overvalued and not determined undervalued, right, the sector rotation is going to take a hit, and that overvaluation in general names is what's going to continue to bring things down. So now we have two factors, right? We talked about the Fed, we talked about the valuations of the market, and we've laid out a few scenarios in which the crash could actually happen, right? Now, the final thing is market bubbles, right? This could contribute to the 2022 crash. Now, everyone's talked about this, the everything bubble, housing, stock market, crypto. I'm probably missing a few, but the everything bubble, commodities. So if that bubble pops, we're going to get a massive spill. Now, this bubble has been popping for the last 10 years, apparently, according to a lot of analysts, but we don't know for certain because the housing market bubble that popped, right? That was a cataclysmic event. Now, if we see a cataclysmic event of such caliber, then yeah, we're gonna get rocked in the market. There's no way around it. But typically, a bubble pop is denoted by 2 standard deviations or 2 sigma of the market. Now, if we consider this, the S&P has about a standard deviation of about 17, right? So about a 35% drop would require a 2 standard deviation move. A 35% drop from highs brings us down pretty heavily. So we'd be on the SPX from 4,800 down to 3,120-ish, right? A very big cataclysmic drop. Now, I don't necessarily think that we get that, but that would be a bubble pop. Now, an everything bubble pop, a super giga bubble pop, would be about a 3 standard deviation move, which is very, very close to the financial market crash, right? The financial crisis crash that dropped everything lower, which would bring us closer to 2,300 on the SPX. So a 51% drop, which is obscene. Now, I don't necessarily think that this can happen without an event like a massive bubble pop or a crisis. So it's very important to understand what these bubbles are, right? Tech bubble, this bubble, asset bubble, that bubble. So all this bubble talk, right? There hasn't necessarily been that many catalysts that lead up to it just yet, but it is something to consider as one of the catalysts for the potential crash. So we have to understand that we are in a different environment, right? The Fed, the political sphere, the monetary policy sphere, right? There have been a lot of precautions taken that weren't necessarily the case in 2007. Even in the 2000s when they had the overall dot-com bubble crash, right? There have been other regulations that have been set in place, right? That ideally save from these kind of massive bubble pops. Now, it's not to rule out that we can't see a 20, 25, even 30% drop in the market, but we've laid out the conditions for that. I think the only way that we see a 2022 market crash is if we have a lot more Fed hawkishness, right? And we have an asset valuation kind of crisis and pop. Now, the asset valuations have already started to shrink, right? And a lot of names are down aggressively from their highs and very far away from the 200-day moving average, which is one of the cataclysmic events, right? If they continue dropping, it's going to pull these indices down. So let's just review. What would cause a 2022 market crash, right? Not to fearmonger, but I think there is a potential to see lower lows in the market before we do turn higher. And I'm not expecting this right now, but I'm expecting it maybe after March before we have a very nice rally into the end of the year. So let's break it down. If we see a 20% drop in the SPX, the S&P 500, that would put us into 3,800s, right? Just below that 4,000 threshold. It is a possibility, right? A 20 to 25% crash from the tops, and I don't think it's going to happen in one swift go, even though that we're down right now 12%, right? A best case scenario is we bottom out around 15%, and then we start kind of rotating and chugging into highs. Now, how could this happen? Let's break it down. This would happen by undoing pretty much all the work that the Fed has done. Right? Imagine the overhype and overinflation of the asset market, right? In terms of financial names and stocks, the overvaluation of those names was stripped away by the Fed, right? What they're doing with inflation and combating inflation by increasing rates more aggressively than already thought, right? Being more hawkish about that, starting the quantitative tightening a lot faster and a lot sooner, right? And the taper a lot more aggressively. So those 3 events and those 3 moves by the Fed with the overvalued already names that people don't really want to invest in would cause a more significant dump. And I think we are gearing towards something like that, but I wouldn't call it a seismic crash of grand proportions, right? I think that they're doing this just in anticipation of something like that. Now, if that happens and the Fed is left without any bullets, then we're really in trouble and we could see that 30, 40% dump even much larger that could wipe out a lot of individual names that have not seen profit yet, right? Imagine the names that are super overvalued without any profit. They're going to become pretty much non-existent, and they're not going to be attractive areas of investment. So not the fearmonger over 2022, but there could be more downside in this market based on these overvaluations and the Fed moves. Now, the Fed hasn't been necessarily too hawkish as of yet in terms of January, but that rate hike is right around the corner. After they bump it up to 50 bips, then guess what? Right? Cramer's gonna be yelling crash all over the news again on CNBC. So keep that in mind, guys. And I hope you enjoyed this super long video. And I want you guys to drop a like. What do you think is gonna happen? Do you think I'm gonna be right? Or do you think the crash is gonna happen later on in the year? Or maybe it's not gonna happen at all and the Fed just saves everyone. Realistically, we're not too far off highs. Remember, we're up 115% from the COVID lows. So a decent pullback, right? We haven't seen one in a very long time, could be in. So let me know in the comments down below before you hit that subscribe button. And what do you think? Drop a like and I'll see you guys next time.